Cassidy. Gerard, I'm going to go to you on this one. Anything there surprise you, particularly when you have those comments from Barr about capital buffers should be larger?
Not really. We were anticipating higher stress capital buffers because of, again, the assumed losses were going to be higher. And what's interesting when we get the details is for the regional banks that don't go through the exam every year, there's a group of them when you're in the category 4 category, you don't go through this exam every year. And the ones that did not go through last year's exam, we'll see if their stress capital buffers go higher, which we expect that they will. They also pointed out, as you just heard, that the Fed is concerned about obviously higher credit losses in credit cards because of higher balances. But again, so far from what we can tell, no real big shock in the news today so far.
Okay. Dave, want to get your reaction to this, especially given the fact that, yes, you had stricter standards baked into the methodologies around these tests this year, but it wasn't necessarily that different of a test in terms of the methodology from last year when we did see the Fed criticized for taking into account lower rates in a severe global recession, even as we had banks fail, smaller banks fail amid higher rates.
Yikes! I'm not sure what higher rates, lower rates. I think I think rates don't matter that much now. What matters to them is credit. They're worried about credit in a big way, and so I think they're still thinking 2008, and they want to avoid a problem that would come from a 2008 downturn in terms of real estate. So I don't think this, Gerard, I think is right. It doesn't really change the outlook for the banks. Doesn't make it a lot worse. Doesn't make it a lot better. It just, tells you that they're focused on credit. And I think the analysts are, and the performance of the stocks this year reflect that.
At my first glance, Gerard, the biggest difference that I see in reaction here is between J.P. Morgan, which in overtime is up about 0.5%, and Wells Fargo. Leslie mentioned that one in not such a great light. That one is down almost 2% right now in overtime. So in essence, are we talking about some banks being in the position of needing to leave more cushion in their reserves because of the stretched consumer, because of delinquency rates, and the Fed pointing that out? And how should investors perhaps consider the stretched consumer differently, if I'm reading that correctly?
No, I think you're reading it correctly. And, Wells has had a big focus on growing their credit card portfolio. They were never a big credit card company like J.P. Morgan. And so as a result, as it was pointed out in just the macro of the entire stress test, there are higher card balances with higher delinquency rates. And we know that when you look at the consumer, it's the low FICO score consumer that is stretched. The higher FICO score consumers are in good shape, especially homeowners who have very low rate mortgages financially are in very good shape. But it's the renters with low FICO scores that are stretched, to your point. And I think what you're seeing in the aftermarket with the trading of the two stocks, Wells Fargo obviously is going to have a larger stress capital buffer than maybe people thought, which is why the stock isn't doing as well as J.P. Morgan.
And so, Dave, what are the possible implications here for smaller banks, those that aren't included in this group of 32, when we consider their exposure to the consumer, perhaps even just in their local neighborhoods?
Well, I think the smaller you get, the less exposure you have to credit cards. Most of the credit card activities in the bigger banks, Capital One, et cetera, Discover, I think there you just have much more exposure to commercial real estate, commercial loans, commercial business loans that obviously are very sensitive to the economy. And then, of course, you have much more sensitivity to the cost of deposits because they rely on deposits. They don't have the use of capital markets or the Fed window like the big banks do. So the smaller you get, the worse it's going to be if there's a recession. I'm interested to note that, it sounds like the regulators are telling you the economy is softening and they're worried about the consumer. So they're saying, hey, the economy's softening, this is going to get worse, and we need to, worry about this and plan on it. So it's sort of an interesting playoff between what the market is maybe saying at all-time highs and what the banks and regulators are telling you on the other side.